Hey guys, good morning. It's Matt Brua with Fairway Mortgage, and just wanted to send a quick rate update and then also give you a quick situation we've been running into a little bit later with appraisals. So just a quick rate update. If you're still thinking about refinancing and you want to go to a 15-year, we're still finding rates in the mid-twos for 15-year fixed mortgages, and that's purchase and refi. But a lot of people have missed out a little bit on the 30-year fixed mortgage because the 30 years have moved up quicker than the 15 years have moved up. So 30 years with really good credit scores are in the lower threes, moving up into the mid to higher threes with lower credit scores. So just want to give you a quick update. But if you thought about refinancing and you ever thought about going to that 15-year now, I think still a great time to be getting involved with that type of mortgage. The second thing I want to talk about today is what happens when a house doesn't appraise out. So what happens when a new purchase goes down and we have a house that doesn't appraise out? So let's say a buyer's paying $300 and the appraisal comes in at $290, which is happening. A couple years ago it was about 9% of the time. Last year was only about 6% of the time, but this year we might run into it a little bit more just because we're in an upward moving market. So realtors are pricing houses of what's coming new to the market. Appraisers are doing appraisals on what's closed on the market. So you're always going to have that variance of what's new and what's already closed. So today it's probably bigger than ever because the market's moving so aggressively. So what happens in that situation is either A, the seller can lower the price. B, the buyer can bring the difference to the closing table, so they can bring that additional 10 grand to the closing table. Or C, the contract can be canceled. Obviously, that's the last situation we want to see happen. So one thing that people don't think about, and this is something you might want to think about, is that if you're putting down, let's say 20%, and your appraisal comes in low at 10, comes in $10,000 less, you can just put a little bit less money down. So instead of having 20%, you might have like say 16% equity, which would trigger the thing what's called mortgage insurance. Now, mortgage insurance nobody wants. Obviously, it's a means to an end. It's a necessary thing when it comes to buying a real estate, and you don't have 20%. But with that mortgage insurance, and you'll have about 14 to 16% equity, that mortgage insurance might only be $20, $30, $40 a month, and then it'll automatically drop off. Once you get 22% equity, that mortgage insurance will drop off. So anyways, thought I'd share that with you. If you have any questions or if you have any situations that you like to run by us, call myself, call my team, 847-487-9915. Thanks so much, guys. Bye-bye.